So in what type of account should you own your dividend stocks? What's up, you guys? Welcome back to the Average Joe Investor channel. My name is Joe, and I've got a quick video for you guys here where we're going to talk about the best type of accounts to own your dividend stocks, depending, of course, on your circumstances. Specifically, in this video, we're going to talk about the two main considerations you need to think about before you decide where to own your dividend stocks. And then secondly, we're going to talk about the different types of cash flow or dividend stocks you can own in your portfolio and which type of accounts make the most sense. This video came as a specific request in the comments below, so make sure you leave your 2 cents throughout the video on any questions or concerns you have. You guys know how much I love to talk about dividend stocks, cash flow, and everything in between. So if you appreciate this video, if you learned something new, add some value to your investments, then hit that like button, hit the subscribe button if you're new, and let's get started. Hey guys, Joe here. If you're new to the channel, make sure to hit that subscribe button below the video to make sure you don't miss any of my future videos. And if you do click that subscribe button, make sure to leave me a comment below saying you subscribed, and I promise to personally respond to your comment. Alright guys, I want to get this video done quickly and get you in and out in case you've got other important things to do, so let's go ahead and jump right into the content. First thing I want to talk about here are the two main considerations you need to think about before you pick an account for your dividend stocks. By the way, this is in no particular order because they're both very important considerations. But the first consideration we're going to talk about here for where to own your dividend stocks, what type of account you're going to use, is what type of tax treatment do these stocks have? This is not a black and white answer because there are so many different options out there for cash flow instruments such as dividend stocks. We've got business development companies, master limited partnerships, real estate investment trusts, and closed-end funds. Each one of these investments is treated just a little bit differently when it comes to how they are taxed, and that is an important consideration for us. The big factor we need to think about is, are these investments taxed right now, or are they known as tax deferred, or do they have some sort of benefit that is realized now and then taxed later? Later in the video, I'm going to get specific on the different types of investments and whether or not they have tax deferred elements to it, or if they're taxed just right now and that's it. The root issue here that we need to think about is if our investment has a tax deferred benefit of any kind, where you are owning it now and you're receiving a tax deferment, you're not having to pay taxes right now, then those investments should generally be held in a taxable account. And the reason why is because if there's a tax deferred element to that investment and you own it in a IRA or Roth IRA where there are already tax benefits built into the account, you're not going to realize both of those benefits. If it's a Roth IRA, you will absolutely pay taxes now on any contributions, and you will then have tax-free distributions in the future. If it's a IRA, you'll have the tax deferred element to it now, and then you'll pay taxes later. But whatever specific to the investment those tax benefits are, you will not realize those. That being said, if your investment has generally taxed right now or every single year when you own the investment, whether it's dividends or capital gains or whatever the investment tax treatment is, then you generally will want to hold those investments in a tax deferred account. The second big consideration you need to have when it comes to what type of account you hold your investments in, your dividend stocks, your cash flow investments, is when do you need the money? So you can really be big on, having really good tax treatment for your investments, and you make sure that you don't have a big tax bill every year. But at the end of the day, if you've decided to put all of your investments in a traditional IRA or a Roth IRA, and you need that money, but you are not age 59 and a half, and there are very, very limited circumstances you can access that money without significant tax penalties. The big root issue here we need to think about is, are we investing in dividend stocks or cash flow instruments for some sort of income before age 59 and a half? Maybe you need it in the next 3 to 5 years, 10 years, and you're not going to be age 59 and a half, versus somebody who's just investing for retirement or is not going to need that money until after age 59 and a half. Well, then that's the big issue here. If we need the money sooner than age 59 and a half, we need to be using a taxable account, or hopefully investing a ton of money in a Roth IRA and then just pulling out the contributions, which you are allowed to do. Otherwise, putting our investments in some sort of a Roth IRA or traditional IRA or 401k is going to prevent us from accessing that money before age 59 and a half. Okay, so let's talk about a few considerations we need to have with respect to individual types of investments. Now, I am obligated to tell you guys right now that I am not a tax professional. I do not give tax advice. I don't know what your situation is. The very first type of investment we're going to talk about here is just your standard standard dividend stocks. Most dividend stocks, depending on your circumstances, pay out what are known as qualified dividends. If your dividends are qualified, then you may pay anywhere from nothing to as high as 20% on your dividends being earned. Assuming you don't have any immediate needs for the money, the general advice that's given and that you can find online is that you should own your standard dividend stocks in a tax-deferred account or a tax-privileged account, such as a Roth IRA or a traditional IRA. And the reason why is because any types of capital gains or the income being received is just standard dividends. That income coming to you or those taxable events are not hitting you at all if they're in a Roth IRA or a traditional IRA or even a 401k account. That being said, if you need the money sooner than age 59 and a half, then maybe it's best to take the tax hit now because you need access to this funds and access to these dividends, like I said, before age 59 and a half. Okay, so your standard dividend stocks generally, unless there's some unique circumstances, would generally be recommended to be held in a tax-deferred account. Let's talk a little bit here about real estate investment trusts or REITs. So specifically here, they have special tax treatment wherein as long as they meet certain criteria, they do not have to pay any type of corporate income taxes. Now to do this, they must pay out, as it says right here, they must pay out 90% of its taxable income to shareholders. Additionally, a REIT must invest at least 75% of its assets in real estate and cash and obtain at least 75% of gross income from sources such as rent and mortgage interest. Now, as it says right here, these dividend payments that come from a real estate investment trust can constitute ordinary income, capital gains, or a return of capital, though generally you're going to see ordinary income. The big issue here is ordinary income is your normal ordinary income tax rates, which for some of you could be as high as 30 or 40%. So again, every situation is a little bit unique here, and like I said, I'm not a tax professional, but the general feedback you're going to get is with respect to a real estate investment trust, unless you need the money before age 59 and a half, you should be holding these types of investments in a tax-deferred account or a tax-privileged account, such as, like I said, a 401k, Roth IRA, or traditional IRA. Let's talk about master limited partnerships. These are a little bit unique and they have special tax benefits. Like a real estate investment trust, to qualify as a master limited partnership, it must earn 90% of its income from minerals and natural resources. Now, something to be aware of with respect to master limited partnerships, when you own part of this company, instead of getting a 1099 DIV and receiving dividends, as a shareholder of a corporation, you are instead a partner in a partnership and you receive distributions instead of dividends. And instead of receiving a 1099 DIV at the end of the year for tax purposes, you receive a Schedule K-1. Like I said, master limited partnerships have some unique tax benefits. The distributions that are made to their shareholders are generally known as return of capital. You are receiving a reduction in your cost basis, meaning that if you had an investment that was $100 per share and you received $1 dividend per share, instead of being taxed now, instead your cost basis would be $99 a share instead of $100, which will reduce. Now this is important because later on in the future, if you were to sell the investment, the capital gain or loss that would be experienced would be based on whatever you sell it for minus what your cost basis is. And if you had this investment for a long time, you might have a significant gain that you are taxed on at that future date. As it says right here, since distributions are return of capital, they are mostly tax deferred, meaning you're getting a benefit now and you may be taxed in the future. But when you sell, you will pay taxes based on the difference between the sales price and your adjusted basis. One of the big benefits for master limited partnerships are how beneficial they can be for estate planning. As it says right here, as long as you don't cash out of the master limited partnership, but bequeath it, that's a crazy word, it to a spouse, or essentially you pass it on to your heirs, then you won't have to pay taxes on your very low cost basis. And whoever then receives that investment from you as an inheritance, they will receive what's known as a stepped up tax basis, meaning that what they bought the stock for or the master limited partnership for is whatever the cost of the investment was at the date of your death, which means that all of that reduction in your cost basis just gets wiped away and they start over for themselves for the tax deferred and the return of capital and the lowering of their cost cost basis. This can be a massive way to receive, for you, tax-free income now and be able to avoid any taxes later. So at the end of the day, with master limited partnerships, because there are tax-deferred benefits to be had with the investment now, generally you would want to hold this type of investment in a taxable account, such as a brokerage account. One thing to be aware of is if you do own this investment in a traditional IRA, Roth IRA, 401k account, there's this thing called unrelated business taxable income, or UBTI. If that number gets too high, and most partnerships do have some level of this every single year, if it exceeds $1,000, you may owe taxes right now this year with respect to that investment and that specific unrelated business taxable income, even though the investment is held in a traditional IRA or Roth IRA. Next, let's talk a little bit about business development companies. Business development companies are just a little bit different here. They primarily will invest in other small or mid-sized companies and lend money to them because they can't afford to get a loan from a standard bank. Now, the income they generate is based on what the income they receive from the underlying investments. It says right here, there are generally 4 types of distributions. There's your standard income, which is from fees and interest. Then you've got non-qualified dividends. That's where you receive dividends from an investment that don't qualify for the preferential dividend tax rate. That would be taxed at your ordinary income rates. Then you have qualified dividends, which are funds paid to the BDC from investments to common stock in private companies that would qualify for taxation as qualified dividends. And then you have return of capital, which this is where your money's coming back to you. Every business development company is going to be a little bit different with respect to how much of each of these types of income that they have every single year, and sometimes it varies year to year. And depending on your investment and the history it has with that company, it may depend on what type of benefits are being received there to determine whether you should own it in a tax-deferred account, such as that Roth IRA, traditional IRA, or a brokerage or taxable account. All of this tax treatment is a moot point though if you need the money before age 59 and a half, because if you invest in these retirement accounts, you can't access the money before age 59 and a half unless you would like to have some significant tax penalties from the IRS. So hopefully this gave you just a little bit more information than you already had with respect to what types of investments you have and which accounts you hold them in. Dividend stocks and cash flow is a great thing to have, and if you have the ability to reinvest your dividends and compound them in a tax-deferred account where you are not paying any taxes, paying any capital gains, etc., that is a massive benefit for you. That being said, there are certain investments out there that are tax deferred in nature, and if you want to realize those benefits now and actually have them, you're gonna need to own those accounts in a taxable account. If you have questions or concerns with respect to tax treatment, please see your tax advisor. Again, I'm not a tax professional and I do not give specific tax advice. Make sure to leave your 2 cents in the comments below, guys. I want to hear back from you guys and know what are some other topics and educational topics you want to learn more about. I want to make sure you guys feel educated and you guys are slowly becoming more able to take on your own investing strategies and learning everything you need to know to have a cash flow portfolio. That's all I got for you guys in this video. Have a great rest of your day, and please continue to stay healthy, both physically and financially. Have a good one.